Welcome to our investment channel. In today's video, we'll calculate Facebook's intrinsic value using real-life examples and financial analysis. Remember, this is for educational purposes only. Like and subscribe so you don't miss future content. Let's begin. DCF analysis is a method that calculates a business' future cash flows and adjusts them to their present value. This is done by considering the time factor, where a dollar today holds more value than a dollar in the future. By graphing the present value of yearly cash flows over time, we can observe a decrease due to the time value of money. Now, let's start our analysis of Facebook's intrinsic value. We'll collect vital data for our discounted cash flow model, including 10 years of annual free cash flows, growth projections, discount rates, and terminal value calculation. Remember, it's crucial to have a deep understanding of the business, its direction, and growth potential before we begin this analysis. Starting with the first year free cash flow, I'll use the most relevant historical data figure, which is $21.2 billion for Facebook. We'll estimate growth rates cautiously using historical data and analyst projections, taking into account the law of large numbers and Facebook's recent growth deceleration. We can gather growth insights from sources like macro trends, financial statements, Philtown's Rule 1 Toolbox, and Yahoo Finance. In our analysis, we're assuming that Facebook's earnings will grow by about 20% each year for the first 5 years and then by 10% for the next 5 years. We're using a discount rate at 10%, which is in line with Monish-Fabry's principles. We're also considering a multiple of 15 for the company's future cash flow, and we're taking into account Facebook's net cash or debt. When we put all these numbers into our model to estimate the company's value, we find that the present value of its future cash flows is roughly $660 billion. It's important to note that we're also considering the company's net cash of $47 billion. So the estimated true value of the entire company is a bit over $700 billion. However, we don't buy the entire company outright, we buy shares. Dividing the total value by the number of shares, 2.4 billion, we get a per share intrinsic value of approximately $295. This figure, though close to the current stock price of $280, doesn't consider the margin of safety we value investors seek. Hence, we apply a 30% and 50% margin of safety to ensure we're not overpaying for the stock. This provides per share intrinsic values of around $206 and $147, respectively. Checking against the market price, we see that in the past year, Facebook's stock reached levels that were close to or even below this margin of safety thresholds. During the market correction in March, Facebook's stock dipped significantly, touching around $150, nearly aligning with our 50% margin of safety. This demonstrates the importance of patience and opportunistic buying during market fluctuations. Understanding intrinsic value analysis is essential for informed investing. It involves grasping a company's fundamentals, forecasting growth, and ensuring a safety buffer. Currently, Facebook's stock price aligns with its intrinsic value, but during market downturns, value investors spot their prime opportunities.